And welcome to ESG. Everyone's suffering guaranteed.
That comes mainly from the US. It's a political argument against woke capitalism.
And our country will be woke no longer.
And the idea that it's detrimental to the economy and society. There's another criticism that it's a marketing gimmick, that asset managers are greenwashing, that they portray their fund as environmentally friendly when in fact they're not.
The market had successfully mobilized trillions of dollars into ESG investments, but we're not moving the needle here. It's all great to sign up for net zero pledges, to state that diversity is at the heart of everything you do as a company. But I wanted to address that all of these inputs, these aspirations, these initiatives haven't yet led to outcomes, right?
Of course, when we say ESG is dying, it doesn't mean that this $50 trillion will disappear overnight. But the money has stopped flowing in and started flowing out. To understand what it means in terms of delivering better outcomes for investors, I spoke to two experts in different fields. One is Alex Edmans, a well-known author and academic. The other is James Lawrence, an investor, head of investment position at Smart Pension. Is the concept really dying? And should we give up on the idea of getting better returns while having a positive impact at the same time? Welcome to Investology. My name is George Ferris. I'm a reformed banker who used to sell sophisticated products to institutional clients across Europe and Asia. But that doesn't mean I was recommending them to my friends and family. This is my channel to discover how to deliver better outcomes for investors through technology, innovation, or just common sense and critical thinking. The concept was born in 2004 in a United Nations report done by the financial industry. ESG stands for environmental, social, and governance. The idea is that you can invest in a way that helps the environment rather than harms it, that advances social aims, and that encourages company to be governed properly with the right checks and balances. And already there, the concept is a little bit problematic because the first two are outcomes, whereas the third, I see it more as a process. Despite of that, it really became popular as a concept after the 2015 climate agreement in Paris, better known as COP21. At the time, this was a great diplomatic success. Almost everyone signed up the document, and we were really going to stop climate change. Yeah. We know that didn't happen. But peak ESG was reached later in 2021 when Larry Fink, the CEO of BlackRock, published a letter to the CEOs that was really all about ESG. And he said, we know that climate risk is investment risk, but we also believe that climate transition represents a historic investment opportunity. And that's the opportunity that everybody embraced. But today, first, the buzz from those COP conferences has really fizzled out. There was a COP29 in December last year, but I personally haven't heard much about it. And in his 2025 letter, Larry Fink doesn't even mention ESG. Instead, he talks about energy pragmatism, and his new focus is private markets and the democratization of alternatives. Anyway, the fact that people are criticizing it or losing interest doesn't necessarily make it a bad idea. But what happened when even sustainability advocates call for the end of ESG?
I'm a strong sustainability advocate. My first book, Grow the Pie, was on the power of sustainability.
I interviewed Alex Edmans, not so much about ESG, but about his book, May Contain Lies, which is about how to deal with misinformation. But he is an expert in sustainability, and he actually had just published a paper called The End of ESG before the interview. I started the conversation probably the wrong way by asking him about metrics, saying when people talk about ESG, they refer to a set of metrics. And Alex corrected me quite sharply, but also rightfully.
Well, you say we talk about certain metrics, so some people talk about certain metrics, but others don't. There's many good investors who practice ESG who don't look at metrics. So they say, well, my clients don't harm me to choose according to metrics. Anybody can do that. Anybody can just look at certain ESG metrics and know, are they high or low?
I must admit that this already shattered my assumption about ESG, but also realizing that I was making a lot of assumptions.
But my skill as an investor is look at what's behind the metrics. Or if I look at the metrics themselves, I don't interpret this as more is always better. Should we always have the lowest possible CEO to worker pay ratio? No, not necessarily. Sometimes actually the CEO does deserve to be well paid. Sometimes a low ratio could be that you're overpaying your workers. So I think what's really important is to understand what is qualitative and not in the metrics, and even the things which are within the metrics, how to interpret them. And it's not always that more is always better, or some cases less is always better.
So yes, I get it. We all have an ESG metrics. I have access to my retail brokerage account without ever asking for them. So if we can all have access to that, they don't make a difference. And when I think about it from an investment management perspective for professional investors, you can use this data as part of the information we receive rather than a classification of the product. But if we go there are two considerations. From a marketing perspective, if you just put things in a box of ESG or sustainable or green fund because they score high on this criteria, it doesn't work anymore if you say this is just information and my decisions is based on that. And also from a political perspective that we started with, it makes it less clear if it's woke or not if you haven't applied the rule automatically. Maybe then being woke is a choice, a judgment, and not an investment policy. So it's important to also get the perspective of a professional investor managing a fund that is known for its green credentials and really not shying away from it. And that's why I spoke to James Lawrence, who's managing pension money for Smart Pension.
Obviously, the end of ESG is quite a headline that grabs the attention. I think some aspects of ESG have been rowed back a little bit on in the past couple of years, for sure. And I think some of that's probably necessary, if I'm being honest with you, because it was forcing behaviours that weren't great for investors or for governments and regulators. We have causing greenwashing. It was causing people to talk about things they weren't necessarily doing. It was causing kind of a lot of noise rather than actually doing anything underneath the bonnet.
Doing something under the hood that can have a meaningful impact, but not a visible one, is exactly the opposite of greenwashing. The perfect marketing move is acting so that you can score on the metrics, but without having any impact. Then he spoke about something that I think is a big unlock.
When we think about ESG, it's that long-term focus. So if I had to summarize our view on ESG, it's investing in companies that are going to be here in 40 years' time. We don't think that, for example, a lot of the oil and gas companies are going to be here in 40 years' time unless they change their business models, for example. Particularly in Europe, that might change in the US, but if we're talking European oil and gas companies, they're not going to be here in the same format. So there's huge business risks to them. We're seeing that with BP and others at the moment. Therefore, we won't invest in them until we can see a viable way forward for them as a business. And a lot of them don't have viable way forwards. They don't have good transition journeys and plans and ways of dealing with stranded assets, changing pipelines to deal with different types of renewable energies, for example. So that's the way we see ESG, is about investing for 40, 50 years' time rather than absolutely kind of blitzing everything that we do using short-term metrics and ratings and completely transforming our portfolio. That's not really how we approach it. So yeah, I'd agree with him to some extent. The ESG has been overblown and it probably needed to come back a little bit, but actually the way we think about it and the way I think he thinks about it is much longer term.
That long-term thinking is the key. And it's also the key in Alex's paper. This is from the abstract.
ESG is both extremely important and nothing special. It's extremely important because it's critical to long-term value. And so any academic or practitioner should take it seriously, not just those with ESG in their research interests or job title. Thus, ESG doesn't need a specialized term, as that implies its niche. Considering long-term factors isn't ESG investing, it's investing. It's nothing special since it's no better or worse than other intangible assets that create long-term financial and social returns, such as management quality, corporate culture, and innovative capability.
I understand better through James' comment on BP in particular, not to pick on them, but they took a view on the company that is long-term And it's actually the only horizon they care about because they're a pension scheme. But I still see a challenge with this approach. Now it's becoming more complicated to communicate. Yes, pensions invest for the long term, but they're doing so for retail investors who are not necessarily informed and who might be flimsy in their choice and not very keen to look into the details and the nuance. It requires that people actually pay attention to that explanation because it's not black and white thinking anymore. But then again, James surprised me by picking perhaps an even more controversial example than energy stocks that I didn't even ask for.
The one that we're coming up against at the moment is defense companies. We've always been out of controversial weapons because I don't think anyone sees a place for landmine producers or cluster munitions or white phosphorus, all those types of companies that just cause completely inhumane outcomes. But actually, we've had a lot of member engagement at the moment about we should be investing in defence, and we should be investing in protecting the UK because we obviously most of our members, or almost all our members in the UK, for example, we don't completely exclude defence companies. We've got some small holdings in them, but they tend to be low holdings because of that ESG focus. So we're doing a lot of work right now as to what the future holds for our defence investing. And I think that's a really interesting discussion in the industry with lots of different viewpoints. So yeah, we're interested to see where that goes in the industry as well.
So you can even invest in defense in weapons, but with nuance. And the other thing is that the opinion of the end user, even in a pension, does matter. But it doesn't fully guide the investment proposition, of course. It's a sort of dialogue. And I think that's where really it's the end of the ESG branding as we know it. And let's face it, this whole $50 trillion in assets, it was also part of an easy playbook for investment manager. You could pick a traditional fund that had stopped growing, and you could give it a new life by applying a few filters on it, not major changes, but enough to be able to rebrand it as green or ESG or sustainable or whatever. But then that raised the marketing question for investment management. How are you going to explain that you're adding value through judgment, a long-term approach, and through nuance? But James's defense example, I think, shows that it doesn't have to be complicated. You do it and you're transparent about it, and people can be engaged in different ways, and now they see their pension and other investment on their phone or in other digital forms. And maybe you can also communicate about it, but it doesn't require a lot more. But that in itself is a fundamental shift in investment management, for pensions in particular. This engagement is something very critical, but that's something I will explore deeper separately. I'll give the final say to Alex Edmans.
But I think anything important about investing is subjective. For example, let's assess the quality of a CEO. That's not an ESG factor. Everybody believes that the quality of the CEO does matter. And this is where the skill of an investor comes in, is to take something which is subjective, which other people can get it wrong, and therefore we might have a better view. So if ESG was just objective, then it'd be really hard to get a competitive edge, because if there was one set of ESG metrics that everybody agreed was correct, then everybody would be putting their money onto it, and you wouldn't even need people. You could just have a computer algorithm doing it. So what I really think is the really exciting potential of ESG is it's messy, you need to get your hands dirty, these are difficult things to understand, and this is where human experience and business judgment really comes to play. And so this is why I do believe that ESG can still be outperforming, even in a world in which we have big data and artificial intelligence.
I would like to add a little nuance to it here. Having metrics doesn't mean we all have the same, and that brings us to the business of financial market data that is booming, and there's a race for differentiating data and more of it. But okay, that doesn't mean we don't need judgment of people, even if the job of these people is to develop systems that use the data. So that's quite a positive outlook for humanity, at least for people working in investment management. If you invest in the long term, if you accept the challenge of nuanced thinking and communications, if you use data to find an edge and apply judgment to it, then you invest sustainably. But That's not different to investing in general. So there's probably a bright future for what we can call sustainable investing and a lot of data that goes into it. But let's just not call it ESG. I hope you enjoy this. It's an unusual type of podcast remix. I had the opportunity to do it because I had some crossover between two guests. If you want to look at the full conversation with Alex and James, I'll put the links in the description. And if you enjoy deep dives on investment management, I recommend to sign up for my newsletter, which is also linked. Thank you very much. And until next time, for further discussions on how to deliver better outcomes for investors.